Everyone, this is Bean's Report. We'll show you our work on some of the manifestations of the globalization of world capital market. Table of contents. 1. Introduction. 2. Overview. 3. Integration of financial markets. 4. Cross-border investment. 5. Rise of multinational corporations. 6. Increased capital mobility. 7. Regulatory framework and governance. 8. Implications for emerging economies. 9. Conclusion. 1. Introduction. The globalization of the world capital market refers to the increasing interconnectedness and integration of financial markets worldwide. It involves the flow of capital across borders, the integration of financial systems, and the interdependence of economies on a global scale. Integration of financial markets. The integration of financial markets connects national markets and creates a global financial market, driven by technology, regulatory changes, and market liberalization. It enhances efficiency and liquidity globally, enabling investors to access various financial instruments worldwide, promoting competition, reducing transaction costs, and improving price transparency. However, financial market integration also brings risks, such as the rapid spread of crises across countries, destabilizing the global financial system. Concerns arise over the concentration of financial power in a few large institutions, potentially leading to market distortions and systemic risks. A. Free flow of capital across borders. The free flow of capital across borders refers to unrestricted movement of money and financial assets between countries. It is closely tied to globalization and the interconnectivity of economies worldwide. This concept involves minimal or no restrictions on money transfers between nations, allowing investors to buy and sell various financial assets without encountering barriers like trade restrictions or capital controls. It manifests in several ways, including foreign direct investment, FDI for short, portfolio investment, the rise of global financial institutions, and the potential risk of capital mobility and financial contagion. FDI involves cross-border investment in productive assets, leading to the growth of multinational corporations, job creation, economic development, and technology transfer. Portfolio investment enables diversification across countries, enhancing liquidity, market efficiency, and access to capital for governments and corporations. The globalization of capital markets has also given rise to global financial institutions like the IMF and World Bank, supporting countries with financial assistance, policy advice, and crisis management. However, the free flow of capital also presents risks, as financial crises in one country can swiftly spread to others through interconnected markets. Effective regulation, risk management, and international cooperation are crucial to reduce these risks. B. Advancements in technology facilitating market integration. The globalization of capital markets has been sped up by technological advancements, particularly in electronic trading platforms, algorithmic trading, and online investment platforms. Electronic trading platforms have revolutionized the financial landscape, providing seamless access to global markets, enabling real-time trading, and enhancing market liquidity and efficiency. Algorithmic trading employs computer algorithms to automate trading strategies, resulting in improved market efficiency, reduced errors, and faster trade execution. Online investment platforms have democratized market access, allowing individuals to invest directly in various financial instruments, offering user-friendly interfaces, educational resources, and low-cost trading options, thereby enabling global participation and portfolio diversification for retail investors. Cross-border investment. Cross-border investment refers to the flow of capital from one country to another for the purpose of acquiring assets, establishing operations, or participating in financial markets. It's a significant manifestation of the globalization of world capital markets, as it promotes economic integration, facilitates capital allocation, and drives international business activities. A. Motivations for cross-border investment. The paragraph describes John Dunning's four-way classification of FDI motives in international business. According to Dunning, firms engage in FDI for different reasons. Natural resource seekers invest abroad to access resources that are either unavailable or more costly in their home country. Market seekers invest overseas to enter new markets or expand their reach beyond exports. Efficiency seekers aim to streamline operations and take advantage of economies of scale and scope or varying factor endowments in different countries. Strategic asset seekers, on the other hand, focus on acquiring or enhancing competitive advantages for long-term success. B. Growth of international investment funds. The growth of international investment funds in recent years has been driven by several factors. Emerging markets like China, India, and Brazil have experienced robust economic growth, attracting international investors. Additionally, low interest rates in developed markets have prompted investors to seek higher returns elsewhere, increasing the demands for international investment funds. Globalization has also played a role, as it has made it easier for investors to access and invest in international markets. Technological advancements have further facilitated this accessibility. However, along with these opportunities, challenges arise. Investing in international markets exposes investors to currency risks, political and regulatory risks, and variation in accounting standards and legal systems. Fluctuations in exchange rates can impact returns, and fees charged by international investment funds tend to be higher than those of domestic funds. Rise of multinational corporations, MNCs for short. MNCs are companies that have business operations in at least one country other than their home country. They play a crucial role in the modern economy. The rise of MNCs has transformed the global business landscape. They have become major players in international trade, investment, and innovation, shaping economies and societies around the world. A. The role of globalization of world capital markets in the development of multinational corporations. The role of globalization of world capital markets is significant and multifaceted. Globalization has enabled MNCs to expand their operations beyond their home countries, access new markets, and tap into resources and talent. The development of MNCs is closely intertwined with foreign direct investment, FDI, which is a key driver of globalization. MNCs utilize FDI to establish subsidiaries, acquiring existing firms, and form strategic alliances in foreign markets. Also, the integration of international capital markets has led to the integration of global value chains, a critical factor in the development of MNCs. B. Some problems of globalization of world capital markets affect multinational corporations. The COVID-19 pandemic had significant effects on global capital markets and especially on MNCs. Cross-border investment flows were severely affected, with recorded amounts of portfolio capital being withdrawn from emerging markets. On average, NMCs suffered a significantly bigger decline in firm value compared to domestic companies. Furthermore, financial crises impact the operations and financial stability of NMCs. Moreover, the concentration of financial power in the hands of a few large institutions can affect the business environment for MNCs. Increased capital mobility. A. Ease of capital movement across countries. Increased capital mobility refers to the ease which financial capital can flow across national borders. It implies that countries have fewer restrictions on capital movements, allowing investors to allocate their funds more freely in search of higher returns and opportunities. One positive impact is the heightened financial integration with the rest of the world. As countries open up their economies to global capital flows, they become more interconnected with international financial markets, which can bring access to diverse sources of financing, increased investment opportunities, and the potential for economic growth. However, there are also potential risks, such as the exposure to global shocks, which can make countries more susceptible to financial crises. A shock or financial instability can quickly transmit from one country to another, and this can lead to increased volatility and the rapid spread of financial contagion. B. Impact of capital mobility on financial stability. The impact of capital mobility on financial stability has been a subject of considerable debate and analysis. While capital mobility can bring about increased liquidity, diversification of investment opportunities, and access to foreign capital, it can also pose challenges. Some studies suggest excessive capital mobility, particularly in the form of large and volatile capital flows, can contribute to financial fragility and increase the vulnerability of economies to financial crises. Rapid capital inflows, for instance, can lead to asset price bubbles, excessive credit expansions, and overvaluation of domestic currencies. Policymakers have implemented various measures, including capital controls. They involve imposing restrictions or regulations on capital flows, either inflows or outflows, to manage the impact on the domestic economy. These can take different forms, such as taxes on capital inflows or outflows, transaction fees, reserve requirements, or restrictions on foreign exchange operations. Regulatory framework and governance. The global regulatory framework for the capital market has evolved due to globalization. Changes aim to ensure stability, reduce risks, enhance transparency, and protect investors. Initiatives involve international and national regulatory bodies, cross-border corporations, international standards and guidelines, and adaptation to technology. International regulatory bodies, including the International Monetary Fund (IMF), the World Bank, the Financial Stability Board (FSB), and the Basel Committee on Banking Supervision, play crucial roles in the global regulatory landscape. These organizations conduct research, issue reports and recommendations, and provide technical assistance to support the development and implementation of effective regulatory frameworks. At the national level, each country has its own regulatory authorities responsible for overseeing and regulating capital markets. These authorities establish rules and regulations to ensure fair and transparent market practices, protect investors, and maintain market integrity. They conduct market surveillance, supervise financial institutions, enforce compliance, and take enforcement actions when necessary. International standards and guidelines have been developed to promote consistent regulatory practices and enhance the resilience of the global financial system. For example, international financial reporting standards ensure transparency and comparability in financial reporting, while the principles for financial market infrastructures establish guidelines for the regulations of market infrastructure. Cross-border regulatory cooperations involve the exchange of information, collaborative policy development, and working towards harmonizing regulatory frameworks. This collaboration aims to address challenges posed by globalization. The regulatory framework and governance also adapt to technological advancements and innovation in the financial sector. Regulators monitor and address risks associated with technologies such as blockchain, cryptocurrencies, high-frequency trading, and digital platforms to strike the balance. Implications for emerging economies. The globalization of the world capital market occurred over a span of several decades, starting in the mid-20th century and accelerating significantly in the late 20th century and early 21st century. The globalization of the capital market began after World War II. Institutions like the IMF and World Bank provided funding and frameworks for international financial corporations. During the 1970s and 1980s, significant turning points with the rise of financial liberalization and deregulation created a more open and integrated global financial system, enabling the free flow of capital across borders. The development of computer technology and telecommunications enabled the creation of electronic trading platforms, interbank networks, and information sharing systems. These technological innovations greatly enhanced the speed, efficiency, and accessibility of capital flows, allowing investors to access global markets and allocate capital with greater ease. Trade liberalization and economic integration also contributed to the globalization of the capital market. Through agreements such as the General Agreement on Tariffs and Trade, as countries embraced trade liberalization, emerging economies with growing consumer markets and favorable business environments became attractive investment destinations. The impact of the globalization of the world capital market on economies has been significant. Emerging economies gain access to a larger pool of global investors, allowing them to attract much-needed capital for investment in infrastructure, industrialization, and economic development, and foreign direct investment play a crucial role in these economies. Conclusion: the globalization of world capital markets has transformed the global financial landscape, bringing opportunities and challenges. Integration of financial markets and increased cross-border investment have opened up new avenues for diversification and growth. However, challenges such as competition and regulatory complexity have emerged. Capital mobility has improved liquidity but also increased the risk of financial instability. Effective regulation and supervision are crucial to maintain stability. Emerging economies have leveraged globalization while addressing vulnerabilities. A robust regulatory framework and governance are essential for managing global capital markets. In conclusion, the globalization of world capital markets has reshaped finance globally, offering opportunities and challenges. Adapting to these changes and implementing strategies for sustainable growth are vital. By doing so, we can harness the benefits and build a resilient global economy. And that has been the work from our group, Beams. Thank you so much for listening. Goodbye.